लॉकडाउन अब अनलॉक करते हैं।
इसीलिए बर्ज एक्सप्रेस पेंटिंग, ऑटोमेटिक मशीन्स, कॉन्टैक्टलेस डिलीवरी और घर की सैनिटाइजेशन के साथ पूरी सेफ्टी, ताकि आपको मिले सेफ्टी भरी खुशियाँ। बर्ज एक्सप्रेस पेंटिंग।
Sometimes it feels like we're stuck in stress. We know mental health is important, but where do we start? Headspace is here for you with tools to care for your mind and take control of everyday anxiety. Be kind to your mind at headspace.com.
Welcome back here with us on Urban Debate on Mirror Now. On Urban Debate at 9 p.m. tonight, we are discussing a crucial aspect of the economy that directly impacts you and me. Inflation, or simply put, mehengai. Now, why it is important? Because at 6.07% in February this year, India's retail inflation, the rate of increase in prices in the retail market has touched an 8-month high. It is above the comfort level of Reserve Bank of India. For policy decisions, this is the number that RBI is always concerned about. The government today also released the wholesale inflation data, and it remains in double digits at 13.11% in February versus 11.8% in September last year. Wholesale inflation has stayed above 10% for 11 months in a row. In fact, the gap between wholesale and retail inflation indicates that companies are yet to pass on the increase in input costs to the consumers, and that's the reason why there is a wholesale inflation, the inflation or mehengai that we see in the wholesale market and the mehengai that we see in the retail market, from where me and you normally buy our stuff like grocery and many other items. Now, in simple words, you will have to now pay more for the goods and services that you regularly buy. Everything that you use in your daily life, from food to footwear to fans to fuel, everything is getting expensive. High inflation means our buying power reduces, the cost of living goes up, value of pension and savings diminish, and of course, it is bad for retirement planning as savings are not going to be sufficient. I'm sure the question on your mind is why? The answer to this is one big global event that has shaken the entire world: the war between Russia and Ukraine. Prices of metals, mineral oils, chemicals, petroleum, food articles in India have already gone up due to the conflict. Now, why is that? Both these countries are major suppliers of components that are used in core sectors of the Indian economy: agriculture, automobile, metals, and oil. For example, Ukraine and Russia export sunflower oil and wheat to the entire world. Ukraine is in fact known as the breadbasket of Europe. The semiconductor industry, on the other hand, is highly dependent upon them for exports of metals such as palladium, neon, helium that is used in making chips. Now, this means that your automobile and IT sectors will also bear the brunt. Additionally, the supply chain of crucial metals such as aluminium and nickel will get impacted too. Now, that's, viewers, only one part of the story. Remember, I said before slipping into this break that on the other side of the short break, my focus is going to be the state of the economy and why it's a double whammy for middle class. Now, the second worrying thing that I want to talk to you about is the sharp cut in interest rate on Provident Fund from 8.5% to 8.1%. This is the lowest interest rate that EPFO subscribers will be getting in over 4 decades. This at a time when already the situation is not looking very good. It's a double whammy for the common man: high inflation, less savings. A cut in interest rate means your retirement fund is now going to shrink. Now, even before the economy could fully recover from the impact of pandemic, the country is suffering with inflation in double digits and cut in savings. And where is it headed from here on? Because the uncertainty between Russia and Ukraine is still continuing. Let's discuss. Joining us on the broadcast right now is Subhash Chandra Garg, former Finance Secretary of India. We will be joined by Mr. Ramesh Chand, former Agriculture Niti Aayog. Professor Arun Kumar, Senior Economist, joining us live, and Dr. Sunil Sinha, Director and Principal Economist, India Ratings, also joining us live this evening. Thank you very much, all of you, for joining us here on Urban Debate on Mirror Now this evening. Mr. Subhash Chandra Garg, I want to begin the discussion with you. How worried are you because of the rise in inflation or mehengai, if we just put it simply for our viewers?
So the inflation is the real worry for all of us, and the numbers you read out are the numbers for the month of February. The situation in March has become worse, both on the wholesale front as well as on the consumer prices front. After the war in Russia and in Ukraine, the supply of crude oil, gas, and many other commodities, and for us, especially the fertilizers and the materials like sunflower oil and a few other things, have also become quite costly. It has also upset the global balance of food grains, and which is now reflected in the food grain prices, wheat and the rice, especially the wheat, virtually doubling all over the world, which is also going to have effect on the wheat prices in India, because now there is more likelihood of the export taking place, which is not a bad thing, which is in a way good thing for us, but that would be reflected in the consumer prices for the food grains. So all in all, whether it is the food, which is currently very low inflation relatively, it's less than 6% food, and which has a very large weight in the consumer index. And then whether you take fuel or you take even services, everywhere the prices are likely to increase. And on the wholesale, the chemicals and the fertilizers, the crude, which is and the petroleum products. So I think there are tough days ahead on the inflation front, and it hurts the poor most, because the poor have no ability to get their wages increased in the way the inflation comes, and the savers also, which also you read out, because the way we are managing the monetary policy and others, the return on the bonds and the investments is much lower. So the incomes don't rise, and the expenditure tends to go up, which will result into a very unfortunate situation where people will have to cut down effectively on their consumption. So I think it's a very, very difficult situation developing.
Difficult situation developing. You also believe we should be prepared for tough days ahead. Mr. Ramesh Chand, in your opinion, how bad is the situation? Can we see some sort of a silver lining only with respect to wheat? Is that an opportunity for India, as Mr. Garg was also talking about?
Of course, in case of wheat, there is a big opportunity. We had surplus wheat earlier also, but because our MSP was higher than international prices, we were not able to export it. Also, WTO regulation, there were some restrictions. So I think as far as wheat crop is concerned, it creates the present situation is a big possibility. I think to call it opportunity may not be a right word, but there's a big possibility. And my own guess is that we will be able to export nearly 10 to 15 million tons of wheat in the year 2022-23. And depending upon where wheat price settles, if it settles around, say, $3.50, then India will have opportunity to earn something between $3.5 billion US to $5 billion US. So I think we should not look only at the negative side of this increase in price. Many a time, the higher international prices prove to be a boon for Indian agriculture, Indian farmers, and many a times high agriculture prices also get passed on to higher wages for agriculture labor. Not always, in many situations that has been experienced, that higher agriculture prices also mean that there will be higher wages for agriculture laborers. So as far as wheat crop is concerned, I see a big opportunity. But in terms of effect on consumer, we should not forget that our PDS system is so strong that India meets more than 40% of cereal requirement through our PDS. So it's a big kind of gain for us, and for economy certainly it will be I would say a very, very positive factor.
Okay. Professor Arun Kumar, now talking about how the inflation scenario is in the country, how concerned are you? And I want to ask you, have we allowed inflation to grow? Because rise in inflation was a concern last year in November too, just before Omicron.
So, we need to really step back a little and see that, the wholesale price index figures that have come out, it was moderating a little bit in the last 2 months and it has accelerated now. And that's why, you see that it's gone up a little bit. And you see, this is not probably reflecting the price rise that has been brought about by the Ukraine-Russia war that is taking place, because the war really started towards the end of February, whereas in March, the disruptions are much greater. So I think the March figures are likely to be much higher, and that's a cause for worry, because as Mr. Garg rightly pointed out, we have a very large unorganized sector which is not able to take care of the prices in the increase in wages. The organized sector to a certain extent is protected, because as the prices go up, their DA utilization goes up and so on, and therefore they have some protection. So in India, because the unorganized sector is very large, the impact of any inflation is usually very large, and therefore consumption, as Mr. Garg rightly pointed out, tends to decline. And when consumption declines, capacity utilization in industry declines, and when that happens, then investment in the economy does not pick up, and when that happens, then the growth rate also does not pick up. So the growth that was slowly picking up, that is likely to be set back as a result of this. And when that happens, then unemployment, rises, because growth is when employment begins to rise. Now, the question is, this wholesale price index reflects the producer prices. It doesn't reflect what the consumer faces. That's the consumer price index. But the wholesale price index feeds into the consumer price index, because a lot of the basic items like fuel, etc., have gone up, and they then feed into the cost of production, and then so on. Now, the second thing that will affect inflation will be that the pricing power of the corporate sector has gone up. So the corporate sector profits are shooting up. The RBI data shows that the corporate profits are going up. Of the sample of, I think, 1,500 companies is going up at 22-24%. So the pricing power of the corporate sector has gone up, and that means that the prices are going faster than the costs. The third thing that's important is our indirect taxes, and especially taxes on fuel that are very high, and that is keeping the fuel prices high. So now that the fuel prices globally have gone up, they may shoot up even further unless the government is willing to take a cut. So the indirect taxes have also contributed to this increase in prices. And then the last factor which is going to be important will be the balance of payment. Because the world economy is going to slow down as a result of the war. Therefore, exports are not going to do that well, except maybe in wheat and a few other items. But overall, the exports are not going to do so well if the world economy faces a recessionary situation. But imports will go up, because our cost of importing crude and gas, that is going to go up, because we import 85% of our requirement of crude oil. We also import coal, and that is going to go up, and therefore that will feed into our import bill. Gold is going to go up, because people are buying more gold because of the uncertainty. And this is what happened in 2012-13, when gold prices went up and fuel prices went up. Then the balance of payment got disturbed, and therefore the rupee started weakening. And we've seen the rupee weakening, and when the rupee weakens, then the imported goods cost more, and therefore that creates inflation. So there are several such routes through which inflation is kicking up. So in spite of demand being low, prices have been going up because there's supply bottlenecks. There are all these other factors because of which prices are going up. So the government has to be very careful because all these different routes through which our inflation is going to go up, they'll have to do something about it. Otherwise, you see what happens is that the consumer price index is only going up at 6% because consumer price index also contains services, whereas wholesale price index does not contain services. So the services prices have not been going up as much, and that's why the gap between WPI and the CPI that you pointed out has been pretty large. But services are also not fully accounted for in the consumer price index.
And but what you're saying is important.
Is higher than 6%.
Something needs to be done. And the government will have to do something now. Dr. Sunil Sinha, the price of war on multiple levels. We'll talk about what are the options in front of the government in just a bit, sir. Let me also take opening comments from Dr. Sunil Sinha. So, Dr. Sunil Sinha, the sense that we've got so far is that this is just probably a teaser. The real price of war, the conflict that's going on between Russia and Ukraine is yet to come in terms of inflation, the mehengai that we are already seeing. What is your assessment?
Look, let me take you back a little bit. In fact, the commodity price increase that we are talking about now actually started almost a year and a half back. I mean, if you go back and start looking at the commodity prices, it started rising from October, November 2020. It became a little more problematic for the inflation sometime in the fiscal year 21. And initially, it was thought that the global commodity price rise, whether of metals or for that matter, oil, etc., may have been caused more by the supply side disruption, which has not been able to keep pace with the fact that as global economy started reviving after the first wave of COVID, the supply side shocks remain, and that's why the commodity prices are increasing. But thereafter, what has happened is that even while this commodity price increase was playing out, now this whole Ukraine and Russia conflict has come about. So it's suddenly going to aggravate the situation, and the bigger trouble or the problem at the moment is that with the kind of price increase that we have seen, and in fact, you stated it in your opening remark that WPI has been in double digit for now 11 months. And if you look at the CPI inflation also, then CPI inflation in most of fiscal 21, on a monthly basis was either close to the upper tolerance band of RBI or was in excess of, upper tolerance band. And even in fiscal year 22, there have been a couple of months when it has been higher. So the situation that is emerging is that this whole inflation piece that we are talking about is not a new phenomena. It has been there. And if inflation remains in the system for such a long period of time, then obviously it translates into inflationary expectation. And that is a much bigger cause of worry, because if that gets entrenched into the economy, then it will be that much more difficult for RBI to really, correct it through the monetary policy. So I think, at this juncture, it's a big issue in front of RBI as to what RBI should be doing with respect to the monetary policy.
Okay, that's an important point you're raising, and I want to go back to Mr. Subhash Chandra Garg once again on this and the question that I had asked earlier also. Have we allowed inflation to grow?
See, the government has been very cautious and careful in not allowing the inflation to grow ever since we had the COVID situation. The policy is followed that you would have a large stimulus, but not effectively any real stimulus. The the fiscal expansion was very low. When when India was faced with rising fertilizer prices, etc., the government absorbed. It continues to absorb very large increases in the fertilizer. So far, the government has not allowed the oil prices also to go up. So my sense is that the government has been more worried about the inflation, and therefore it had constrained demand, leading to this situation where consumption has fallen in the economy quite a lot. We are still not at the level at pre-COVID, despite 2 years having gone. But now I think you have reached to a situation where you perhaps at the limit, the government can't any longer absorb this. A very tough decision will have to be taken about the oil prices sooner than later. Do you make excise cuts further, or you allow the prices to be passed on to consumer? And if they do, then certainly there would be a further impetus to the inflation. What my worry, which is bigger, is that so far, since the fiscal management allowed the inflation to be contained in the country, the RBI was able to keep the interest rate very low and allowed the government's borrowing program to be funded. I think it's no longer possible for the RBI to do it. And therefore, in times to come, now it will be the RBI, which has been more growth focused rather than the inflation focused, will have to change its tack. If it doesn't, and it continues to do the pump priming and the growth financing, then we will have an outcome where the inflation will simply spiral out of the control, and we will have a very tough situation.
Okay, Professor Arun Kumar, so RBI will now have to be more growth focused than inflation focused as it was so far. Is it then time for interest rate to start going up? And also my another question to you is, amidst all of this, you know, we have seen our PF interest rate being slashed. Do you think that was the right decision? Because already inflation is hitting the people of this country. Already the savings are not very high. So many people have lost jobs because of COVID pandemic. And amidst all of this, the only saving that people really rely on, at least the people who are working, even that will not be sufficient.
So, you know, we are in an indeed very difficult situation, as you know, Mr. Sinha was also pointing out. RBI's task is cut out, you know. It is likely to actually reduce availability of liquidity. That's happening globally, because in the US, etc., also there's a worry about inflation. Interest rates there may rise, and therefore here also we may have to raise interest rates in the economy. But the economy is already slowing down because of the war, because of the recession in the global situation. And therefore, you know, you don't want the growth to come down further. So that's the catch-22. If you do something on inflation, growth slows down. If you do something on growth, then the inflation kicks up. But let me also say that it's really not actually the remit of the monetary policy, because a lot of the factors which are causing inflation, which I listed, are coming from outside. You know, they're not within the national economy. So, for instance, as Mr. Sinha was rightly pointing out, the global commodity prices have been going up. Now that, you know, you cannot control by changing monetary fiscal policy here. Similarly, if food prices go up because the global food prices go up, then that also, you know, only to a limited extent through PDS you can control, but otherwise not. So in a sense, the
right.
fiscal policy and the monetary policy will have a very tough time, because, you know, here we may have to lower indirect taxes so that, you know, the fuel prices don't continue to rise, and, you know, so that demand remains a little more buoyant than it will be. But then we have to raise direct taxes, otherwise the fiscal deficit will go up. So therefore, what I would suggest is that cut taxes on fuel and try and raise some extra resources from, you know, where the gains in the last 2 years in the stock market and capital gains, etc., that have been made, the corporate profits that have grown dramatically in the last 2 years. So I think, a balancing of that would be very essential at this point. Thirdly, I would say that, the interest rates will rise in the Indian context because globally the interest rates are likely to rise. So this EPFO cut at this point of time doesn't quite make sense. Why is it that the EPFO rates have been cut at this point of time? The interest rates are likely to rise everywhere. And I think already there are some signs that the commercial banks are raising interest rates on fixed deposits because they want to get more,
Yes.
deposits going. Then, with regard to foreign exchange, we have high foreign exchange reserves, and therefore that can be used to see that the rupee doesn't decline very dramatically, which would feed into inflation. So I think that management of foreign exchange and prevention of the decline of the rupee, that would be an important factor. So I think the task of RBI and the fiscal monetary policy of the country, that is cut out, and it has to be very sensitively dealt with. Otherwise, we are going to be in a bad situation where inflation will kick up and the rate of growth will go down. So some kind of a stagflationary situation could result, which would then affect the pocket of the unorganized sector, the marginal sectors, and especially the micro sector, which was already in trouble after demonetization. That could be further in trouble as the economy tends to face these problems.
Right. Okay, among all the suggestions that you've given, I think one is very, very important, and that's about cutting taxes on fuel, and probably the government can look at raising revenue from other sources. Mr. Ramesh Chand, do you think that is going to be the right thing to do? Because as far as the agriculture sector is concerned, even that's going to get impacted because transportation cost is going to go up, and fuel prices have been the largest contributor of the rise in inflation that we have seen both at the wholesale level and at the retail level, impacting the food inflation eventually.
You see, already government is absorbing much of the increase in crude oil prices that has happened internationally in recent weeks. So you don't see that that increase is passed on to the consumer. It has been absorbed by the government. So
increased won't be passed on. That's the sense we are getting. But will there be a reduction? Because our tax component is quite high, both at the central level and at the state level that we pay today.
I'm coming to that since Professor Arun Kumar mentioned about reducing the taxes on petroleum products. That's why I made this point that the increase in international prices in recent weeks, particularly post-Ukraine war, has not been passed on to consumers. And there has been a big increase in crude prices. I think it will depend upon how long this war lasts and how long the sanctions on Russia remains. That is going to have significant effect on crude prices, and government will be watching this situation, how events are unfolding, and then take this decision. But we should not forget that if government is not allowing passing on of some prices to consumer, then effect will come on fiscal deficit. And that will also get reflected in some way on inflation. So it is not that easy that you lower tax on petroleum and then consumer will pay lower price. The indirect effect may set off, neutralize, if not entire, a part of it. As far as food inflation is concerned, it is happening mainly through import, because we are importing half of our requirement of edible oil, and that price also increased very sharply in the last 1 year. So recently, it is not increasing, but it already, among all food commodity, the highest increase is seen in the case of vegetable oil, but it is already passed on. So I feel that this higher export and effect on domestic prices through higher prices for import will have some impact on food inflation, but not too much, And one reason for this is that the second advance estimate shows that we are going to have a record production of almost all food commodities. Record production of cereal, record production of pulses, even record production of mustard and oilseed. So we are expecting record production, very good growth in agriculture, something close to 3.5%, whereas domestic demand is growing something around 2%. So I feel as far as agri-food sector is concerned, we will be repeating story of the past that when international prices go high, not only our export increase in dollar terms, even our share in global trade also increase, export also increase. So we perform much better than other countries when prices are high. So
you believe that fuel inflation, given the current circumstances, will not impact the food inflation for sure. Interesting point there. I want to quickly go back to Mr. Garg for his quick comments on EPFO, then Dr. Sunil Sinha on his prescription for the government in a situation like this. Mr. Garg, very quickly, as Professor Arun Kumar was saying earlier, that EPFO cut doesn't make any sense at this point in time. Do you also believe it was the wrong decision because it is hurting?
No, Hina, I think you can't fault it for the interest rate decision. Interest rate depends upon the earnings you made in the year, and that is to be distributed. You can't distribute from anywhere else. There is no subsidy provided by anyone to give a higher rate of interest. This is the result of what the EPFO earns by the kind of investment it makes. So either it will have to change its investment pattern, or the interest rates will have to rise in the economy so that they can earn higher. So that's not something you can fault them with.
Okay. Dr. Sunil Sinha, I want to give you the last word now. What is your prescription to the government in a situation like this? Because mehengai is a cause of big concern. And I want to ask you, can the government and RBI still remain in this wait and watch mode? Or do you think some immediate intervention is the need of the hour to protect the middle class, to protect the people here?
Of course, much would depend upon how long the war lasts, and thereafter how long the sanctions last. So that is what is going to dictate much of what we should or we should not do. But assuming that this whole situation doesn't last beyond maybe another month or so, I guess when I look at the Indian economy at the current juncture, if you look at the rate of inflation, it is very high. If you look at the GDP, it is not in the best of the situation. You look at the current account deficit, still somewhat manageable because we are expecting that it will be, of course, before the war, we were expecting that it will be somewhere around 2.3% of GDP. And if you look at the fiscal deficit, then it is very high. So when you look at these couple of macro parameters, then suddenly few of the parameters are giving you signs that there is a strain. But at the same time, there are other parameters which is still somewhat giving you the comfort. I think the best part at the current juncture is that when you look at the corporate sector and the banking sector, in fact, in the last decade, what we had seen is that much of the problem was due to the twin balance sheet problem. I mean, on the one hand, the banks were bleeding, on the other hand, corporates were bleeding. So neither of them were in a position to really absorb any shock and move forward. However, at this juncture, the last 2 years, the corporates have really been able to deleverage themselves. So they are in a better shape. Banks have also been able to deleverage their balance sheet. So they are also in a better shape. So they can certainly provide and kind of accept the shock that is coming to us due to the global developments. But as Professor Arun Kumar was mentioning, that's still a very small part of the economy. The larger part of the economy is actually the MSME, unorganized sector, and that is where the real challenge would lie. That how do you address their problem? I mean, corporate sector can survive, the banks can survive, but what do you do with the unorganized sector, which is a very large sector from where the demand comes? And as such, the consumption demand that we are witnessing in the economy clearly indicating that there is a dichotomy. On the one hand, there are certain items for which demand is still intact or maybe even growing, but there are many other items for which demand is simply collapsing. So these are some of the challenges, but yes, there are both positives and negatives.
All right. Thank you very much, all of you gentlemen, for joining us here on Urban Debate on Mirror Now on this very, very important issue. We'll, of course, see what the government does from here on, because Mehengai is a reality today. It's impacting each one of us directly and indirectly. This is what the inflation data has suggested. But as Mr. Garg and other guests also mentioned, that this is not even telling us the impact of Russia-Ukraine conflict. That's yet to come. That happened in March. So what will the government do is what we are going to keep a close eye on. For the moment, thank you for joining us here on this debate. Heading into a short break. On the other side, we'll tell you the latest as far as Russia-Ukraine crisis is concerned. Stay with us.